Hey everyone, this episode is brought to you by Mantra, the security first, compliance focused L1, which is onboarding the next wave of financial institutions. You're going to be hearing all about them later in the show, but for now, Mantra, thanks for making this episode possible.
Welcome back to another episode of On the Margin, and joining me today is Andy Constan of Dance Spring Inviters. Andy, it's really great to finally connect with you. How are you doing?
Felix, it's a pleasure to meet you in real life, sort of, and I look forward to conversation.
Well, let's get right into it. You've been on the show a few times in the last few months, and you've regularly talked about your economic framework that you build into being basically these islands. I'd love to just get a bit of a recap on what is that, what are the islands, and also where do you stand today in terms of what island you're sailing to or where you're at on that.
Right. So I want to start by saying I've had a bad call in terms of market timing lately. Made some good trades, but by and large, I've been fading this equity rally. And so, I trade bonds and stocks and other things as well. I think it's important to start with, for most of the listeners, including myself, the best way to invest is to be long assets and never touch them for 20 years. And that's what most people should be doing. On my Twitter feed and in podcasts like this, I try to add value in terms of my understanding of market direction and market timing. And I've had a bad call. So this conversation most likely will be about the more interesting things about market timing. But again, that's not my strongest investment advice to the extent that no one makes investment advice. We all should be long assets and hold them forever. Now, as it relates to market timing, I've thought about the world in a few different ways that I think are now getting to be well understood by most. And that is that the economy will stay strong due to a variety of factors, which we can go into in depth, and will stay above trend growth and will likely stay above desired inflation. And that combination of things will require the Fed to stay higher for longer. So that's one place, higher for longer island. And I think we're heading back there after a pause for the last couple of months where it looked like we would either land softly or head to a worse place, a recession island. And in a recession island, the economy shrinks below trend. In a classic recession, goes negative growth. Jobs are lost. Unemployment rate goes well above what it currently is. And non-farm payrolls see job losses. And inflation almost invariably falls in those situations. And that's sort of the recession island. And then there's this magical place where the economy, even after all this stimulus and all this hiking and cycle, miraculously ends up at target inflation and target growth. And we all are rooting for that. I mean, that is, nirvana, paradise, Goldilocks, whatever you want to call it. And I don't mean it in a derogatory way. That would be the best outcome for society. It just seems unlikely to me, given the various pressures that are in place. And at this stage, after this couple of months, 8 to 10 weeks of negative data surprises, and I think that's been passed around a lot, the surprise index, have all been on the soft side. Jobs have been pretty robust, but you can always look anything half empty or half full. But inflation has come down consistently, and survey data like ISMs and PMIs have fallen, and real GDP is not quite as levitated as it has been. And so after 8 to 10 weeks of that sort of negative surprises, we reached a point where everyone now is convinced and has priced in significant rate cuts in the short term.
First off, what do you think was driving this, I've heard you call it slowing but growing blip that we've been in the last couple of months? Is it financial tightening from the Fed, from Fed funds, or what do you think has been driving it?
Right. So, the Fed funds rate is the principal way that the central bank toggles the economy from tight to loose. And there's a tremendous amount of research on the topic. The Taylor rule is sort of the poster child of how to think about that. And the Fed hasn't, I think it'll, on this meeting, it'll be the 1-year anniversary of rates at the current rate. And so the Fed really hasn't done anything. Now, the markets have wildly anticipated actions by the Fed. As many as 7 cuts were priced in at year end in 2023, as the year started this year. And it's possible we have none. Now markets are pricing 3. When I think about what it takes to slow the U.S. economy, and what I think about what it takes to stimulate the U.S. economy, it tends to be it tends to be not only the short rate. Now, back decades ago, the short rate was a very important rate for central bankers. And in countries that have floating rate mortgages, which is every country,
Canada, where I'm at, yeah,
which is every country but the United States, basically. I think Netherlands has a fixed rate mortgage market. The short rate still matters a lot in those countries. But I would say, and have said many times lately, that since the low interest rates of the post-GFC world, and then the, once again, extremely low interest rates during COVID, in a country that has borrowers that can lock in long-term rates for 30 years, the U.S. economy just isn't as sensitive to shifts in the short-term rate as other countries. And for that matter, the U.S. prior to maybe even the 2000s, it's the short-term rate really works by targeting those who borrow and lend on the short-term rate. And one of the key participants that borrows and lends on the short-term rate are banks. And to the extent that you want to slow an economy, you make the cost of funding of a bank more expensive by raising rates. And so they tighten borrowing. In this day and age, where $18 trillion of bank deposits are willing to accept at least 75% of those bank deposits are willing to accept 0 interest rates to keep their money on deposit with banks. The bank funding mechanism isn't working. The banks are still funding at 0, and you can see that in the NIMs of the big banks. The net interest margins, which everyone expected as rates rose would fall because the cost of funding went up, hasn't shown up. The cost of funding hasn't risen dramatically. And so that tightening of raising short-term rates on banks hasn't worked. If you look at the asset portfolio of banks, they have essentially flatlined their asset growth for 3 or 4 years. And so one would say, well, that is representative of tightening financial conditions because they've purposefully stopped extending credit, when the opposite is true. No one needs the credit. Banks are able and willing, because they're able to source 0 interest deposits and charge credit spreads plus maturity spreads, to lend, and they just aren't. And that's because demand is not there, which says that the private sector just doesn't need the money. It is rich with wages and it's rich with savings, and so doesn't need to fund new consumption or investment with leverage. And so the short rate isn't going to affect the economy in the United States. So I think there's this myopia that is part historical. When you look at the Fed and you look at the characteristics of the various Fed officials, John Williams is a very important spokesman, runs the New York Fed, which is the second most powerful position on the Fed, because they actually act for the Fed in terms of the markets. He says R-star's not going up. He says he's a big Taylor rule proponent, and he has at least Powell's ear. And so the Taylor rule is saying cut. Now, lots of different people would say how much. The Fed has its own published reaction function that you can look at with the SCP median dot plot. Mm-hmm. And they say, based on the economy before in May, they say 1 cut. They'll probably say 2 or 3 if they actually decide to cut. But they're looking at the Taylor rule. And another half of the committee, I think, is less certain. Mm-hmm. And that's the part of the committee that I think focuses on financial conditions, which says, how does this economy really work? And then there's this wealth effect idea, which says that the wealthiest of Americans are asset rich and have raised I saw a chart that has U.S. household wealth at 170 trillion and up 30% for the last couple of years. And so their balance sheet is extremely liquid. And so to me, I think that's where you think about whether the economy is financial conditions are tight or not. And my read, and the Fed seems to disagree with me, and markets clearly agree with me at some basic level. Mm-hmm. Financial conditions are extraordinarily loose at the moment.
Yeah. Hey everyone, this episode is brought to you by Mantra, the security-first, compliance-focused L1, which is onboarding the next wave of financial institutions into Web3. So you guys have heard me talk about Larry Fink talking about tokenization. You've seen the clips on CNBC. You know that Larry and BlackRock are very, very excited about this idea. And the reason for that is they're looking at these trillions of dollars of off-chain real-world assets. They want to digitize those and bring them on-chain, which is going to be a massive opportunity. But in order to do that, they need a compliant L1, and that's where Mantra comes in. Mantra's been steadily climbing the ranks and now stands among the top 4 RWA projects on CoinGecko, which is representative of its rapid growth and influence in the tokenization space. Mantra's built using the Cosmos SDK, so they have some very cool stuff out of the box. They've got IBC interoperability. They also leverage CosmWasm smart contracts. Very cool design from an architectural standpoint. The next phase on the blockchain's testnet is Hongbai, so that's launching soon. So if you're a dApp developer or something like that, there's a lot of very cool opportunities for you. And I highly recommend that you click the link at the bottom of the show notes. That'll know that I sent you. Thanks very much again, Mantra, for making this possible. And again, guys, click the link at the bottom of the show notes.
You could maybe call it this financial conditions loop that's been ongoing. And, anytime we see this slight slowdown, we've just been through that. And this is what's been so hard is that, okay, now, as of today, it looks like the September cut is basically at 100%. And so as that occurs, things start to reaccelerate again. We're seeing home builders start to, surge this week, starting to see people really just go all in on that idea. As that occurs, it's a lot of what you talked about how that starts to impact the economy quite quickly. So as we're starting to see this potential soft spot, some people are calling recession. It sounds like you mostly don't think so. So maybe we can tie this into a little bit of the dynamics on the long end of the yield curve as well. But what do you think is next here based on that loop that keeps occurring?
The important thing that I'm mentioning is not that expectations for rate cuts are driving financial conditions. Like, I get the idea that if the market thinks that there's 100% certainty of a September cut, that has some influence on the asset market. But the primary influence on the asset market is animal spirits on the expectation of the economy, the outcome of the economy. And that is how much credit and at what cost is it available to make investments, to consume, and to make financial investments. And the financial conditions, not what's happening on the front end, but the financial conditions will stimulate the economy. So my view is that the financial conditions are stimulative at the moment. I don't really honestly, I think the amount of attention that's placed on the short rate market is totally appropriate if you are a SOFR futures trader or a 2-year note trader, and you're trying to gamble on the path of interest rates. But
Mm.
if you think that the economy is being impacted by that, I think you're missing the big picture. And the big picture is the economy is being impacted by what's happening to assets.
Mm.
And assets have had extremely good performance, which is stimulative. So what does that mean for the future? I expect so let's just step back for a second. So financial conditions to me are the goal of changing the short rate. That the Fed is not dumb and knows that no one is borrowing at the short rate. And what they do with guidance and that lever is affect the long rate, which affects all asset markets. And the market front runs them. And so the Fed is signaling a cutting cycle by the SEP and by the half of it that's dovish. And markets are front running that. And that's stimulating asset prices, which is stimulating the economy, which is defeating the purpose that the Fed had in cutting rates. So, and I think it operates very quickly on the economy. And again, this is just my opinion, and it's not based on science. It's just based on my observations over the years, is that when financial conditions were very easy, the economy did well. And when they tightened meaningfully, like they did in September and October last year, the economy weakened rapidly, really slowed down. The same thing happened when financial conditions were the most tight in this cycle, which was in October of 2022. As soon as they got so tight that the economy then responded, we had our first negative inflation print, which caused a big easing as markets presumed that the Fed was done. And this time around, once again, financial conditions tightened, that the economy weakened, and we had a easing by the policymakers, and the economy strengthened. This most recent patch, there is something to the idea that rates have been higher for a lot longer than most expected. And so there might be some marginal impact of keeping Fed funds at 5.25% for the last year. But I think what happened is the market cratered in both bonds and stocks in April, and financial conditions tightened, and the economy slowed in May and June. And now we're going to see the economy, and we're just getting that late. All the data is coming in from May and June, not from July and August. And we'll see in July and August that the easing of financial conditions has stimulated the economy.
So if we just use, say, the 10-year yield as a shorthand for when this discussion, a couple of weeks ago, the 10-year was at 4.5%. We're at 4.19 today. That's been significant. In a couple of weeks, there's the QRA refunding announcement coming from Treasury. That has had a significant impact on the long end, as you've been, totally on it for much longer than any of us else on in financial media. So, based on that, do you see it going higher? And what's your view on this coming QRA and just the long end in general?
I think financial conditions have been stimulative over the last few months, and the economy is going to respond. And so and everyone now is conditioned for weaker than expected prints in all the major economic prints. It's likely that we get surprised on the upside, like we did today with the retail sales number, and like we probably have. Let me just make sure to check that. Like we probably will on the GDP Now figure that'll come out it's not out yet. Oh, there it is, up 0.5%. It's now it's moved from 2 to 2.5.
Yeah.
Now, why is that? Why does retail sales, which everyone expected to be crap, the whisper number was super negative, and it came in very strong. And not only that, the CPI number that was for that basket was of things that are measured in retail sales was negative 0.4%. This change in in retail sales indicates that the real economy is reigniting, and we're back up to 2.5%. Now, the markets ignored that. Bonds are strong. Stocks are strong. Stocks should be stronger than bonds, and if the economy is reigniting, there's no doubt about that. But bonds are ignoring it, and and that's because it's only the first positive surprise on the economy. I expect over the next couple. So, what do we have? We don't have much between now and the PCE. The PCE is going to surprise on the upside, well, based on yesterday's forecasts, but because import costs surprised on the upside, it's probably going to be on the high end of the range. So that's our next big data. We're going to get a bunch of jobless claims between now and the September meeting. I expect it to be strong. I expect NFPs to surprise on the upside. I expect CPI and PPI in August and September to surprise on the upside. That's bad for bonds.
Mm-hmm.
Now, the question is it bad for short rates more than long rates? It's bad for both. But at 75 basis points of cuts priced in for 2024, it's pretty bad for short rates. If you ended up with you do this all the time. If you ended up with a 3% PCE, what are they going to have done in 2024? Are they going to have cut?
Yeah, no.
They're not going to have cut.
No.
What if we start getting numbers like that? We're going to go to no cuts in 2024, and that's 75 basis points. What will that do on the long end? It won't do 75 basis points. It won't put us out to 490 on the 10-year. So my guess is in the short term, we're going to get bear inversion, a bear flattener, which is more inversion to keep that your guess. And so that would be my near-term view. Now, does that mean that I would want to short the 10-year? I am short the 10-year. Well, I'm actually short the 30-year, but I'm thinking about shorting the 10-year some more here. I think where the lows for the 10-year are in for the year at current rates.
Yeah.
So I'm pretty bearish on the 10-year, but I think I'm more bearish on the 2-year. That should be good for equities. But, and this is the important, and we'll come back to the QRA because that's where you want to be. That should be good for equities if the rebound is strong enough to meet the expectations built into equity pricing, which is for a 30% increase in earnings over the next 2 years. And I think that's a real question, but I think a lot of the equity market move has been on expectations of cuts. And if those disappear, I would expect equities to outperform bonds, but not outperform cash. So that's my synthesis.
Yeah.
In terms of the QRA, so firstly, what's the QRA? The QRA tells us in over 2 different releases, one on July 29th and July 31st. On July 29th at 3 p.m., we will be told how much the U.S. government is going to issue in total net for the fourth quarter, the first fiscal quarter, the fourth calendar quarter. They're also going to tell us if they need to increase or decrease the issuance in the current quarter, but that's less important. One of the key elements, I'm just telling you what I'm going to be looking at. One of the key elements for that number is whether they decide to change the amount of money they have set aside for a market disruption event. The Treasury keeps a large amount of money that is meant to cover over any future 5-day period, the amount of money they're going to have to pay for assuming they cannot issue at all. And this is a September 11th, 9/11 situation where the markets were closed for 5 days.
And that gets housed in the TGA?
Yes. Well, everything that the government does gets housed in the TGA. But what the TGA is like your checking account. Taxes go in. Issuance proceeds go in. Now, that's the one that they're worried about being cut off for 5 days. And government spending, which is the interest they pay that we were talking about, and also all the government expenditures that are part of the primary budget, go out. Those are still going to need to go out in a market disruption event. And the amount of money they pay back bondholders when bonds mature. And so you take those three things that happen regardless of a market disruption event and you net them. And the TGA is kept at a level that says, what if I can't issue for 5 days? And so that level is around $800 billion. And if you forecast that, which is easily doable, it takes work, but it's doable, you're going to see that that's not going to change. But there are some market participants that believe that the administration is going to want to pump the economy by, instead of tapping liquidity to issue new bonds, they spend the Treasury General account. And that's a conscious decision, and the impact to say you don't actually spend the TGA. You just continue to pay your interest, you continue to pay your expenditures. What you don't do is issue new bonds to keep the level up. And the lack of issuance means that there's more liquidity for other things in the economy, including financial assets. And so there's some participants who think Janet is going to pump the economy by spending down the TGA. And really what that means is reduce issuance in the fourth quarter. Now, the reason why they think that is because she's done it many times. The TGA has fell from a December 22 level of $750 billion to $42 billion in June of 2023. That makes all the sense in the world if you have a debt limit where you cannot issue. And so they were balancing, hey, we've got this policy that says we always want to have 5 days of money in case we can't issue, which is a policy, and another policy which says we don't want to default. So we want to continue to pay we have a debt limit. We've hit the debt limit. We want to pay our bills. And so the only choice when you have that is for one to compromise the other policy. Is the default policy overwhelms. And so that's what they did. Now there's nothing like that in the next month. So on July 29th, you're going to see that number, and you're going to see the TGA, and we'll see what it'll be. I don't think it'll be changed, but others do. And then the next day, after the Treasury Borrowing Advisory Committee meets with the Treasury Department with the mandate to say, okay, here's how much we need to raise. How do we raise it? They will determine whether they issue the same amount of coupons, less coupons, or more coupons. And the reason why they start with coupons is because bills are liquid. And if they think that they are issuing too few coupons because for whatever reason, they can issue more and issue less bills. If they think they're issuing too many coupons, they can reduce the amount of coupons and increase the amount of bills. And that's the discussion that's had. And one thing we do know is that since the last QRA, the budget deficit has gotten worse. And that means that interest has increased as an expenditure, and taxes have decreased versus their estimates on the income. The spending hasn't really changed because there's basically been gridlock. So they have a bigger deficit to fund, so they're going to have to issue more. And so now the question is, will they issue more coupons and demand the investor to take on more risk, or the same or less? And so that's the thing I'll be looking for.
Hello, listeners of On the Margin. I've got good news for those of you who are in the crypto scene. Blockworks is bringing back Permissionless. We're going to be doing Permissionless 3, and this year we are heading west. So we're moving that out to Salt Lake City. That's going to be October 9th through 11th. this year. We've got a phenomenal lineup of speakers for you. So we've got Balaji headlining, we've got Sriram Munib, Matt Hogan of Bitwise, Jan Van Eck. This one's going to be a blast, guys. And I saw many of you out in London for DAS this year, and I hope to see you out in Salt Lake for Permissionless. And because y'all are such faithful listeners, we've got, if you use code MARGIN10, you're going to get 10% off your tickets. Appreciate you all. Hope to see you out there.
I'd love to pull us a little bit out of this rabbit hole and circle back to, ending this conversation with how you started it. You had mentioned about how, you got a call wrong, but at the end of the day, we don't build portfolios entirely just based off chasing alpha, right? Like you have a beta underlying that just, it's holding assets for multiple decades. And that is very a key point for a lot of people. Now, I think, what's been tough is when you look at what happens on financial Twitter or whatever, and like people just see those singular, calls and miss the forest from the trees. So I would love to just hear, you've spent decades as a professional money manager, risk manager. Could you just expand a bit on that chasing alpha all the time versus just having that core beta? Because I think a lot of people miss that, and how, even though you maybe made the wrong call on equities, you weren't blown out or something this year. Like you still made some money. What do you?
Right. I think it's extremely important to recognize my public Twitter account as being fun for me. Hopefully I'm adding value. Hopefully I'm adding some interesting conversation, but I don't do myself any favors. I tweet red days and green days and, stupid things that make no sense as a professional investor to do, but it was fun for me. So I bring it on myself a little bit. So let's step back and say, what are you trying to accomplish? And you can look at my my pinned tweet on my Downspring account. Beta is free money. If you hold assets for long enough, you are the casino. All the gamblers who come in that want to consume today to pay back later. Give me a hamburger on Tuesday, and I'll pay you back on Tuesday. That's a really old reference. Those who want to consume, they borrow from the casino, which is you and me. Those who want to invest in the real economy, corporations, who want to spend in the public sector, in the private sector, governments, they come to us. They come to the casino and say, "Lend me money. I'll sell you a share of stock for that money. I'll sell you a bond for that money. I'll sell you a mortgage," whatever it is. You are the casino, they pay you. And all you have to do is diversify and hold that risk for a long period of time, and you're going to outperform cash. Now, you aren't going to become wildly wealthy. That's not what investing is about. Investing is beating cash, beating inflation through time. That's all it is. Otherwise, you just put your money in cash. And so it's free money. Now, that said, the entire industry, including this program, including my work, everything we do is about beating beta. And it's a zero-sum game. Whatever beta is going to pay. And the people that are active position managers who deviate from beta either go short, go less long, underweight, overweight, buy tech stocks, rotate into Russell stocks, whatever it might be, whatever the fashion is and whatever the good trades are, take that money from somebody else that's trying to do the same damn thing. There are a lot of really, really good people out there. And then there are these guys that are rent collectors that tax both of us, both the guys that are trying to buy and the guys that are trying to sell for alpha. We've got middlemen that tax us, market makers, transaction costs of all sorts. And so the stakes are really high with great competitors on both sides and a tax that we have to pay to play. It's a bad deal. You shouldn't do it. But everybody on the planet tries. Anybody that is not passive is active. If they are active, they are betting against somebody else who has just as good information. How do they have an edge? And so, yeah, it's really, really, really hard to have alpha, and most people don't have it. And I wonder every single day whether I have it. And it's not because of my recent performance. Who the hell cares about? I mean, you can be 55% right. If you are, you have alpha, and you're 45% wrong all the time. That's pretty crappy, and it's part of the game. So at any one outcome, you're going to have a slump, and then you're going to have some hot streaks. So the question is, why do we try to do it? I don't honestly know. I wish I did, but
Yeah,
to be honest, I think it's just a very, very difficult game, and so we have to be respectful of that. And so that really comes down to work ethic, understandings, openness to learn, willingness to, and then what I do is risk management. Like, okay, I may not have alpha. How much should I bet? If I'm confident I have alpha, like if you know you're a card counter and the deck is rich, you know what to do. You bet more. And if you can read a poker player, you bet more. And if you can't, you bet less or not at all. And so risk management is that process. And so and then the most important thing for most alpha seekers is to not to keep playing. As shocking as it is, the worst thing for an alpha player who doesn't have alpha is to keep playing, right? Because they're consuming transaction costs and they have negative alpha. But the best thing for a person who actually does have alpha, and I believe some do, is to keep playing, and that means don't blow up. And so, I can't lose more than 10% at any one moment. If the worst possible thing happens to me, 100% of my positions, even the ones that are hedging each other, go to their worst loss. The most I can lose is 10%. Currently, I think I have a 3% of my AUM at risk. Like, am I taking a big swing at it?
No.
I'll have 97% of my money at the end of the year if it goes bad, and maybe I have, 106, 107% if it goes well. So, and while my beta is just ticking along, collecting the free money. So that's how I think about it.
Nice. I think that was very well put, and I think a lot of people miss those points and get really caught up in the action that occurs. And I think we're both guilty of that sometimes too. But look, Andy, it was really great to connect with you. I've really enjoyed our conversation, and appreciate all that you contribute for all of us.
Absolutely, Felix. Anytime.
Awesome.
And nice job. You're really growing there, and it's really quite impressive.
Thanks, Andy. Appreciate that.